With the arrival of a new U.S. administration committed to an economic agenda focused on tax cuts, deregulation, and a more protectionist stance, the U.S. economy in 2025 is likely to see accelerated growth. However, this expansion may come with significant challenges, from increased fiscal deficits to rising economic inequality and international trade tensions. Below, I've outlined each of these areas in greater detail. 1. Economic growth and tax reduction. Stimulating private investment. A central pillar of the administration's economic strategy is the implementation of tax reductions aimed particularly at corporations and high-income individuals. This approach is designed to encourage these groups to reinvest in the economy, creating a domino effect of growth and expansion. By lowering corporate tax rates, the government aims to make the U.S. a more attractive place for businesses to operate, discouraging offshoring and motivating both domestic and foreign companies to invest in American infrastructure, technology, and workforce. This tax relief increases companies' disposable capital, enabling them to fund expansion projects, adopt new technologies, and hire more workers, ultimately boosting productivity. For high-income individuals, tax cuts are intended to incentivize reinvestment in the economy, particularly in areas like the stock market, real estate, and business ventures. The theory is that, with increased disposable income, wealthier individuals will make capital available for funding startups, expanding businesses, and purchasing properties, which, in turn, should create more jobs and drive demand in other sectors. Though this trickle-down approach is often debated, the administration believes that empowering these high-income earners will ultimately benefit the broader economy by creating more opportunities and increasing aggregate demand. Effects on demand and supply. With more resources available, businesses across various sectors are expected to see a rise in demand for goods and services and an enhanced ability to meet that demand by expanding production. In particular, sectors like manufacturing, energy, and technology stand to benefit significantly, as these industries often require substantial capital for machinery, advanced technology, and a skilled workforce. Tax reductions provide these industries with the necessary funds to invest in new equipment, pursue research and development projects, and pay competitive wages to attract skilled labor. This investment can create a multiplier effect throughout the economy, as increased business activity in these sectors generates demand for a range of other goods and services, boosting the overall production chain. The administration anticipates that the policy will also benefit specific regions of the U.S., particularly the Midwest and South, where a robust industrial infrastructure exists but has struggled due to offshoring, automation, and market shifts over the past few decades. By incentivizing the expansion of manufacturing and industrial production, the tax cuts could help revitalize these regions, providing new job opportunities and stabilizing local economies. Additionally, with increased demand for labor, wages in these areas could see upward pressure, offering a much-needed boost to household incomes and spending power in historically hard-hit areas. Fiscal deficit and long-term sustainability. However, while tax cuts are designed to stimulate growth, they present the significant risk of increasing the fiscal deficit if not paired with corresponding reductions in government spending. By lowering tax revenues without cutting public expenditures, the government may face a widening budget gap. To finance this deficit, the government would likely need to issue additional treasury bonds, effectively increasing the national debt. As the debt level rises, so do the interest payments on that debt, which means the government will need to allocate more of its budget towards servicing this debt rather than investing in essential areas such as education, healthcare, and infrastructure. Over time, a growing debt burden can become a drag on economic growth, as the government may be forced to raise taxes in the future or reduce spending on public services. This scenario could hinder long-term economic sustainability, especially if the economy slows or enters a recession. Furthermore, Higher interest payments may restrict the government's flexibility to respond effectively to future economic challenges or crises, making the economy more vulnerable to shocks. Finally, the reliance on debt financing may also lead to rising interest rates as the government competes with the private sector for borrowing. Higher interest rates can increase borrowing costs for businesses and consumers, reducing investment and spending in the private sector. This could ultimately counteract some of the initial stimulative effects of the tax cuts, leading to a complex balancing act between short-term growth and long-term fiscal health. Balancing these elements will be crucial if the administration is to achieve sustained economic growth without compromising the country's financial stability in the years to come. 2. Deregulation and impact on the private sector. Opening opportunities for innovation and sectoral growth. The new administration's deregulation agenda is aimed at eliminating bureaucratic and regulatory barriers that, in its view, hinder business growth and innovation. By relaxing or eliminating certain regulations, the government intends to create an environment where businesses can more freely pursue new ventures, invest in innovation, and grow without facing extensive compliance costs. This approach is seen as a way to boost competitiveness across sectors and stimulate a more dynamic economy with fewer regulatory obstacles to market entry and expansion. In sectors like energy, easing environmental restrictions could enable oil, gas, and coal companies to expand operations and explore untapped reserves that were previously difficult or costly to access. This would potentially increase domestic energy production, reducing U.S. dependence on foreign oil and energy imports, which is considered critical to national security and energy independence. By allowing greater exploration and extraction, the administration hopes to create jobs and boost regional economies, especially in states with rich natural resources. For instance, investments in extraction and refining in areas like the Permian Basin, Appalachia, and the Gulf Coast could provide economic opportunities, attract ancillary businesses, and strengthen infrastructure in those regions. The deregulation of environmental controls could also stimulate new technology development in energy extraction, such as fracking, horizontal drilling, and carbon capture. By lowering regulatory compliance costs, the administration aims to incentivize research and development in technologies that make extraction more efficient and cost-effective. This could lead to technological advancements that not only reduce production costs, but also enhance the competitiveness of U.S. energy on a global scale. Additionally, deregulation may encourage growth in other sectors dependent on affordable energy, such as manufacturing and heavy industry, further boosting job creation and economic growth. Risks to stability and the environment. Despite these potential gains, deregulation also carries significant risks. In the financial sector, reducing restrictions on lending practices may encourage banks and other financial institutions to engage in high-risk behaviors to maximize short-term profits. Deregulating financial practices can enable banks to provide loans with fewer safeguards, which may temporarily increase consumer spending and business investment, but could also raise the likelihood of defaults and instability in the credit market. A historical example is the 2008 financial crisis, where relaxed lending regulations allowed banks to issue subprime mortgages to individuals and institutions that were ill-equipped to repay them. When these loans began to default en masse, the housing bubble burst, triggering a global recession with long-lasting economic repercussions. In the environmental sector, the deregulation of protections and restrictions on fossil fuel production may have adverse effects on sustainability and climate goals. Increasing fossil fuel extraction could lead to higher levels of greenhouse gas emissions, undermining efforts to combat climate change and pushing the U.S. further from its climate goals. While deregulation may stimulate economic activity in energy-producing regions, it may come at the cost of environmental health, as expanded oil, gas, and coal extraction risks increased air and water pollution, habitat destruction, and a greater overall carbon footprint. For example, in the case of the energy sector, Relaxing standards on methane emissions or water protection regulations can lead to environmental degradation that not only impacts climate but also affects public health and local ecosystems. The administration's focus on fossil fuels may also reduce investment in renewable energy sources like wind, solar, and hydroelectric power. Renewable energy industries, which typically rely on incentives and regulatory support to grow, may struggle to compete with a revitalized fossil fuel sector operating under fewer restrictions. As a result, the U.S. may lose ground in the global transition toward clean energy, lagging behind other nations in developing sustainable energy solutions and potentially compromising its future competitiveness in this critical sector. In conclusion, while deregulation can stimulate sectoral growth, lower business costs, and promote energy independence, it also poses risks to economic stability and environmental sustainability. The challenge for the administration will be to balance the potential short-term economic benefits of deregulation with the longer-term needs of a stable financial system and a sustainable environment. 3. Labor market and income distribution. Expansion of jobs in traditional and energy sectors. With the administration's focus on revitalizing traditional industries such as manufacturing, construction, and mining, there's potential for significant job creation, particularly for workers without advanced education or specialized skills. These sectors have faced substantial declines in recent decades due to globalization, technological advances, and automation, which have reduced the demand for low and medium-skilled labor in certain regions. However, with the new economic policies encouraging domestic production and deregulation, the demand for workers in these traditional sectors may increase. This could lead to reopened factories, expanded mining operations, and new infrastructure projects, especially in areas with existing industrial infrastructure, such as the Midwest, Appalachia, and parts of the South. The energy sector, specifically oil, gas, and coal industries, may see notable growth as environmental regulations are loosened, allowing for the expansion of extraction and refining operations. This expansion could create jobs in exploration, drilling, extraction, and transportation, particularly in resource-rich states like Texas, Wyoming, and West Virginia. Additionally, these jobs often pay relatively high wages compared to other industries that require a similar level of skill, potentially improving income stability for blue-collar workers in these regions. Moreover, an increase in such jobs could reduce unemployment rates in rural and industrial areas that haven't benefited from recent tech-driven economic growth. This resurgence in job opportunities might help stabilize economically distressed communities and reduce reliance on government support in these regions. Economic inequality and wage stagnation. However, while these policies could create more job opportunities, there's a risk of widening economic inequality as a side effect. Much of the new administration's economic agenda, including tax cuts and deregulation, is designed to benefit corporations and high-income individuals under the assumption that these benefits will trickle down to the broader economy. While this approach may increase overall job creation and GDP, the distribution of economic gains often skews toward the wealthiest segments, leaving middle and lower-income groups with a smaller share of the benefits. One issue is that tax incentives aimed primarily at corporations and higher-income groups may not translate into significant wage growth for lower and middle-income workers. When corporations receive tax cuts, they might reinvest profits in ways that benefit shareholders, such as stock buybacks or dividend payouts, rather than focusing on wage increases. This means that while more jobs may be created, the wages offered may not rise at a pace that keeps up with inflation or the cost of living. Without substantial wage growth, workers in lower income brackets may experience stagnant real income, limiting their purchasing power and ability to save or invest, which affects their long-term financial security. Furthermore, wealthier individuals typically have a lower marginal propensity to consume, meaning that each additional dollar of income is less likely to be spent in the economy than it would be for lower-income individuals. When the majority of economic benefits are concentrated at the top, overall consumer demand may not grow as strongly as expected, potentially dampening the long-term impact of economic expansion on the broader population. This concentration of wealth could have a ripple effect on long-term consumption trends and limit the economic multiplier effect, as wealthier individuals tend to save or invest additional income rather than spend it on goods and services. Ultimately, these factors could exacerbate income inequality and economic stratification, creating a gap between higher-income households and the rest of the population. This gap may lead to social and economic challenges, including decreased social mobility, as limited income growth restricts opportunities for advancement among lower-income groups. Additionally, increasing inequality could strain social cohesion and reduce consumer confidence, as more Americans feel economically insecure and left behind. Balancing job creation in traditional sectors with policies that promote fair wage growth and address inequality will be crucial to ensuring that the benefits of economic growth are shared more broadly across the population. 4. Inflation and Federal Reserve monetary policy. Inflationary pressure. The administration's economic policies, especially tax cuts aimed at boosting consumer spending and business investment, are designed to stimulate demand across the economy. However, these policies could also create inflationary pressures if the surge in demand outpaces the economy's capacity to supply goods and services. When aggregate demand grows faster than productive capacity, prices tend to rise as businesses face constraints in expanding production quickly enough to meet the increased demand. This scenario is particularly likely if there are bottlenecks in sectors that produce essential goods or if labor shortages emerge in certain industries, limiting the ability to scale up production. Inflation erodes purchasing power over time, meaning that consumers are able to buy less with the same amount of money. This is particularly challenging for low-income households, which tend to spend a larger proportion of their income on necessities like food, housing, transportation, and healthcare. When the prices of these essential goods and services rise, lower-income families are disproportionately affected, as they have less financial flexibility to absorb higher costs. This increase in the cost of living can lead to financial strain, reducing disposable income for non-essential purchases and, in severe cases, forcing families to cut back on basic needs. As inflation persists, consumer confidence may decline, as households become more cautious with spending, fearing continued price increases and uncertainty about their financial future. Federal Reserve's interest rate adjustments. If inflation rises beyond the Federal Reserve's target rate, the Fed will likely need to raise interest rates to control the rate of economic expansion and curb inflationary pressures. Higher interest rates work as a cooling mechanism by making borrowing more expensive, which tends to reduce both consumer spending and business investment. When credit becomes more costly, consumers may reduce their spending on big-ticket items, such as homes, cars, and appliances that are typically financed with loans. Sectors like real estate and automotive are particularly sensitive to interest rate hikes, as higher borrowing costs can dampen demand for mortgages and auto loans, potentially slowing growth in these industries. For businesses, higher interest rates increase the cost of financing investments in equipment, infrastructure, and expansion, leading companies to delay or reduce their spending plans. This decrease in investment can slow job creation and impact wages, especially in sectors dependent on capital investment, like manufacturing, construction, and technology. As a result, economic growth may slow, and job creation could decline, which could counteract some of the initial stimulative effects of the administration's tax cuts. The Federal Reserve will face the challenge of maintaining a delicate balance. Raising interest rates too quickly could slow the economy too much, potentially leading to a recession, as reduced spending and investment across sectors could contract economic activity. On the other hand, if the Fed keeps rates too low in an effort to sustain growth, it could allow inflation to continue unchecked, creating risks of a consumption and asset bubble. This situation may lead to overvaluation in markets such as housing and stocks, where rising asset prices are driven more by easy access to credit than by fundamental economic value. To manage this balance, the Fed is likely to adopt a gradual approach to rate hikes, aiming to curb inflation without triggering a sharp slowdown in economic activity. However, if inflation becomes persistent and begins to exceed acceptable levels, the Fed may need to take a more aggressive stance, prioritizing inflation control over short-term growth. This careful maneuvering will be critical to avoiding both economic overheating and a potential downturn. The Fed's policy decisions in response to inflation will thus play a crucial role in shaping the U.S. economic outlook, as interest rates impact not only inflation but also broader economic conditions like employment, household spending, and business expansion. 5. Trade policy and international relations. Protectionist trade policy. The new administration is expected to adopt a protectionist trade policy aimed at reducing the United States' reliance on imported goods and prioritizing domestic production. This approach will likely emphasize policies that encourage American consumers and businesses to buy American. To achieve this, the administration may introduce higher tariffs on imported goods, particularly from countries seen as economic competitors, such as China. By increasing import taxes, the government seeks to make foreign goods more expensive and, in turn, incentivize consumers and businesses to purchase domestically produced products. In addition to tariffs, the administration could provide tax incentives or other benefits to encourage American companies to shift manufacturing and supply chains back to U.S. soil, a strategy known as reshoring. Such protectionist measures are designed to safeguard U.S. jobs, particularly in sectors that have faced stiff competition from low-cost international labor, such as manufacturing, textiles, and electronics assembly. In the short term, these policies could boost employment in these traditional industries by creating demand for locally produced goods and materials, potentially revitalizing economically struggling regions that have been affected by decades of offshoring. The administration's focus on domestic production could also foster new investment in American infrastructure, including in factories, transportation, and skilled labor development, strengthening the country's capacity to produce goods internally. Impact on supply chains and product costs. While protectionist policies may support certain U.S. industries, they also pose significant risks for global supply chains and could lead to higher costs for American consumers. Many U.S. businesses, especially in industries such as automotive, technology, and retail, rely heavily on imported parts and components that are integrated into final products. For example, a US-made car might include electronics from Asia, steel from Canada, and machinery parts from Europe. If tariffs are imposed on these imports, the production costs for these goods will likely rise, as manufacturers will need to either pay more for these imported components or find US-based suppliers, which might charge higher prices due to local production costs. These higher production costs are often passed on to consumers in the form of higher prices for finished goods. For instance, if tariffs are raised on imported electronics components, the prices of consumer products like smartphones, computers, and household appliances could increase. This could lead to inflationary pressure on consumer goods, disproportionately affecting lower-income households that allocate a larger share of their income to essential products. Furthermore, as American businesses and consumers adjust to these higher prices, they may reduce their consumption, potentially dampening economic growth in the long run. Additionally, if the U.S. imposes tariffs or trade sanctions on major trading partners like China or the European Union, these countries might respond with retaliatory tariffs on American exports. This escalation could reduce the competitiveness of U.S. goods in global markets, as American products become more expensive for foreign buyers. Industries that rely on exports, such as agriculture, automotive, and aerospace, could suffer, as they face reduced demand and lose market share to competitors from other countries. For example, if China imposes tariffs on American agricultural products in retaliation, U.S. farmers may struggle to sell their goods abroad, leading to surplus supply and declining prices at home, which can financially harm agricultural communities. Furthermore, escalating trade tensions with major economic powers could increase diplomatic strain, impacting broader international relations beyond trade. These tensions could complicate collaborations on issues that require global cooperation, such as climate change, security, and technological standards. In cases where trade disagreements spiral into prolonged disputes, the U.S. may find itself isolated from key international allies or engaged in costly trade wars that disrupt economic stability. Such conflicts can destabilize markets, create uncertainty for businesses, and reduce investment both domestically and internationally. In summary, while a protectionist trade approach might protect certain U.S. industries and promote job growth in the short term, it also brings potential downsides. The costs of goods could rise, negatively impacting American consumers and businesses that depend on imported materials. Additionally, international trade tensions could weaken diplomatic relations and reduce the competitiveness of U.S. exports, requiring the administration to carefully balance national economic interests with the realities of an interconnected global economy. 6. Real estate sector and infrastructure investments. Expansion in the construction sector. With the administration's corporate tax cuts and incentives for business investment, the real estate and construction sectors could experience significant growth, particularly in commercial and industrial property construction. These policies are intended to make capital more accessible to businesses, which in turn may lead companies to invest in new offices, manufacturing plants, and distribution centers. This investment boost is likely to benefit construction companies and related industries such as engineering, architecture, and materials supply, e.g., steel, concrete, lumber. An increase in construction projects will likely lead to job creation across various skill levels. Positions for laborers, electricians, plumbers, and equipment operators are expected to increase as new construction projects get underway. This demand could stimulate local economies in areas where development is concentrated, especially in regions outside of major urban centers where commercial and industrial construction could lead to economic revitalization. For example, if a manufacturing plant opens in a smaller town, it could create a ripple effect by supporting other local businesses like restaurants, retail stores, and service providers, benefiting the broader community. Additionally, the focus on infrastructure improvements, often including roads, bridges, and utilities, is expected to be a key aspect of the administration's agenda. Increased federal support and private sector incentives may spur public-private partnerships for large-scale infrastructure projects, further driving demand in the construction sector. Improved infrastructure not only supports construction jobs but also enhances logistics and transportation, making it easier and more cost-effective for businesses to move goods and materials, which can improve overall economic efficiency and growth prospects. Impact of interest rates on housing affordability. However, the potential for growth in the construction sector comes with a significant challenge for housing affordability, especially if interest rates rise as the Federal Reserve acts to counter inflation. Higher interest rates lead to more expensive mortgage loans, which can discourage potential homebuyers from entering the market. As mortgage costs increase, monthly payments on new loans rise, reducing the pool of buyers who can afford to purchase homes. This can lead to a decline in demand for residential properties, as middle and lower-income households face greater barriers to homeownership. For many families, rising interest rates can mean delaying or even abandoning plans to purchase a home, as the cost of homeownership becomes prohibitive. This decline in demand could result in a slowdown in the residential real estate market and potentially reduce housing construction in some regions. However, developers may shift their focus toward building high-end properties that cater to wealthier buyers less affected by interest rate hikes. This trend could lead to an imbalance in housing development, With a surplus of luxury homes but a scarcity of affordable housing options, particularly for first-time homebuyers and lower-income households. As a result, the gap in housing accessibility could widen, exacerbating housing inequality. Lower and middle-income families may be forced to rent instead of buying, increasing demand for rental properties and potentially driving up rental prices. This dynamic could put additional financial strain on households that already face high costs of living, leaving them with fewer resources to save or invest. In high-cost cities, the affordability crisis may intensify, pushing families to seek housing further from urban centers, where prices are lower but commute times are longer, impacting quality of life and adding to transportation expenses. In summary, while policies that boost commercial and industrial construction may spur job creation and local economic growth, higher interest rates could limit residential real estate demand, pushing homeownership out of reach for many. Balancing the expansion of construction with affordable housing initiatives will be critical to ensuring that economic gains in the real estate sector translate into broader benefits for all income groups. In 2025, the U.S. economy, under the new administration, is likely to see strong growth in sectors such as energy, manufacturing, and construction, driven by tax cuts and deregulation. These policies aim to stimulate private investment, create jobs, and revitalize traditional industries, particularly in regions that have struggled economically. However, this growth comes with significant risks. The fiscal deficit could widen as tax cuts increase government debt, leading to greater long-term financial strain. Additionally, economic inequality may rise, as the benefits of growth may be disproportionately concentrated among wealthier individuals and corporations. Inflation could also be a concern, as rising demand from tax cuts may outpace the economy's ability to supply, pushing prices up. The Federal Reserve might respond by raising interest rates, which could slow down growth and affect access to affordable credit. Protectionist trade policies could strain international relations and increase costs, as tariffs and trade tensions disrupt global supply chains.